Charles D. Ellis, Winning the Loser's Game, Timeless Strategies for Successful Investing. Dive into the world of successful investing with the book, Winning the Loser's Game, by Charles D. Ellis. This summary provides a clear understanding of time-tested strategies that help individual investors navigate the complex financial markets. Focused on insightful lessons from tennis, the diminishing information advantage of professional traders, and the importance of index funds, the book shatters conventional wisdom and provides a realistic roadmap for individuals to achieve their investment goals. Delve into important themes such as market efficiency, portfolio management, diversification, and understanding long-term investment horizons as the author reveals the common pitfalls and mistakes that could hamper your financial journey.
The loser's game of investment. The traditional idea of beating the market through superior investment management is no longer valid. Institutions with advanced technology dominate the market and establish the prices of stocks. While some funds may outperform the averages in a given year, sustained outperformance is uncommon. Most fund managers underperform market indexes due to fees and expenses, and individual investors perform even worse than professionals. The reason investing has become a loser's game is that efforts to beat the market are now the most significant part of the problem. Institutional investing used to be a winner's game, but it is now a loser's game, similar to amateur tennis, where the final score is determined by the loser's errors. Therefore, amateur investors need to focus on avoiding mistakes rather than trying to outsmart the market. The challenges of investing. Investing can be a challenging task, especially when it comes to sticking to a long-term plan despite market fluctuations and emotions. Investment advisors can offer guidance, but their fees could eat into the returns. Moreover, active managers have to generate more than 10.25% to match market returns, taking into account operating costs. Outperforming peers requires exploiting their mistakes, which is increasingly tricky in today's market. Trading volume has surged, and quantitative and algorithmic trading have taken over, making the markets more efficient. Similarly, information is no longer an advantage, and there are millions of investors with equal 24-hour access to financial data. Investment firms cherry-pick funds with good returns to showcase their success, but this can be misleading, and it can be hard for investors to beat the market. The advantage of index funds. In the book, The Intelligent Investor, Ben Graham explores the concept of price setting among institutional investors, arguing that it is a collective effort that relies on access to the same data. To beat the market, you must beat these professionals, and opportunities to get ahead are rare. So why does the market still rise and fall? It's because of how other market participants think and anticipate moves. Long-term investors should not be distracted by short-term market movements, but instead focus on studying market history to better understand its behavior. Graham recommends using index funds, which replicate the market's performance and can provide returns that most actively managed funds cannot. This approach also brings less tax liability and charges lower fees. Index investors will still experience fluctuations, but they don't have to worry about their investment manager's timing being off. Many investing experts, including Warren Buffett and Nobel laureates, recommend indexing for most individual investors. By using an index fund, investors can effectively assemble a team of the most knowledgeable and experienced professionals in the world, supplementing their advice with research from the best analysts. The formula for successful investing. Investing has two risks: investment risk and investor risk. Active investment costs more than it returns, and indexing is the answer. The index investor can concentrate on developing a portfolio that reduces the probability of error and enhances the likelihood of achieving objectives. Diversification optimizes the risk-return trade-off, and the most prudent investors will choose a fund representing a total market. Every investor has a zone of competence and a zone of comfort, and it is important to stay within both. Investment portfolios should be tailor-made for an investor's age, assets, risk tolerance, and other characteristics that differ from person to person. Only you as an investor can set your investment policy, whether or not you collaborate with a professional advisor. Straying from the competence zone leads to expensive blunders, while getting out of the comfort zone carries the risk of irrational, emotional decisions. Winning investors are in competition only with themselves. Holding on through thick and thin can help long-term investors realize expected returns, hence the need to understand how capital markets work. The strongest argument for indexing occurs in the major markets, and individuals should avoid narrowly focused, specialized exchange-traded funds, while professionals use these to tweak their risk management. Time and investment, a crucial consideration. The S&P 500 returns were highest on less than 1% of the trading days over the last 20 years, and missing the best 5 days of trading in 72 years can reduce a portfolio's returns by half. Although market timing is not effective in investing, time plays a crucial role. The portfolio time horizon increases the possibility of returns approximating the average expected returns. The returns of stocks, bonds, and cash differ based on the holding periods. The most critical consideration in investment policy is the proportion of equities and fixed income investments, and the conventional recommendation of a 60% equity to 40% debt may not hold for a long-term investment horizon. Economic and market forces eventually move towards the average, and investors who evaluate future prospects by looking into the rearview mirror assume upward momentum. Furthermore, investment history shows that, on average, stocks return more than bonds, which return more than money market investments. The volatility of returns increases the shorter the investment time span. Winning the stock market with index funds. Investing in index funds provides the diversification that eliminates individual stock and stock group risk, essential in managing market risk. An expert consensus of the overall market is needed to win if taking individual stock or stock group risk. Short-term gains are unlikely, as over 90% of actively managed mutual funds underperform their benchmark index. The appropriate objectives and asset mix are essential investment decisions. The stock market can be a maze, and investors must be careful to avoid falling into the trap of mistaking luck for skill. When investing in individual stocks or stock groups, the only way to win is if the expert consensus of the market is wrong about the investment's value. However, index funds offer diversification to eliminate individual stock and stock group risk. Managing market risk is essential in investment management. In the short run, it's all too easy for individual investors to mistake luck for skill. Over 90% of actively managed mutual funds that invest domestically underperform their benchmark index, and only 11% can match their index over a 15-year time frame. Investment firms can even give investors falsely positive impressions of their fund performance. As such, the most important investment decisions are those that define the appropriate objectives and asset mix. Investing for a better lifestyle. Individual investors tend to view money differently from institutional investors, as they often attach sentimental value to the funds they have accrued throughout their lives. When planning for retirement, investors should focus on concrete saving goals that will enable them to achieve a better lifestyle. Minimizing fees, taxes, and expenses by indexing is essential when investing savings, and inflationary expectations should also be taken into consideration. Contrary to popular belief, equities are the best long-term investment for individuals, even for older investors, as their portfolios may have a longer timeline. By investing in equity index funds, investors can think about their beneficiaries and secure their futures. The book emphasizes that achieving financial stability in retirement is an exciting accomplishment and encourages readers to embrace saving as a positive endeavor.
In summary, Winning the Loser's Game delivers powerful insights into successful investing strategies that outlast the ephemeral gains of active management. By recognizing the significance of index funds, the changing landscape of market efficiency, and the value of diversification, individuals can achieve greater long-term investment success. Adapting to the realities of today's highly efficient markets and relying on time-tested practices, Investors can establish an effective investment policy uniquely suited to their goals and risk tolerance levels. The key is to stay informed, think long-term, and focus on a tailored, disciplined, and strategic approach to investing.